Year-end tax planning for 2024. It's a fun topic. Let's talk about it. Welcome to the Modern Wealth Management Educational Series. I'm Dean Barber, along with Marty James. Marty's Managing Director and CPA in our Indiana office. Marty, thanks for taking time to join me here on the Educational Series.
Hey, I'm glad to be here.
So we're going to talk today about some tax planning tips for as we round out 2024 here. And, you're a CPA. You've been a CPA for 40 years or so, and maybe more. You've been written up in the Wall Street Journal multiple times, and so I think that all of our viewers and listeners are blessed to be able to get some of your expertise here for as we round out 2024. But we need to look into 2025 and 2026 as well. So let's get started.
Yeah, we're laser focused on the next 3 years. So for 2024, we're still under the Tax Cuts and Jobs Act provisions. So nothing's really changing. So a lot of the things we've done in the past, we're going to continue to do with, like the Roth conversion strategies are pretty much the same. People need to be looking at if they can itemize their deductions, by, possibly, donor advised funds and things like that, things we've always done. The other critical thing to really look at is really check your withholding and your estimated payments. Since interest rates have gone up, those underpayment penalties are a lot more. So really take a look at that going into year end.
Let's go on that one just for a minute, Marty, because I don't know that most people really realize that their underpayment penalty is tied to what interest rates are. Talk about that a little bit.
Yeah. So, back in the day, not too long ago when interest rates were much lower, it wasn't so bad, when you actually missed your estimated payments or didn't pay in enough to avoid paying that penalty. One of the things the IRS expects you to do is pay in throughout the year based on what your income is. And most people, this happens through their withholding, so there's really no issue other than if there's major changes in the tax rates and they end up being behind or something like that. You get, it's a surprise at the end of the year. But there's, safe harbor things that you look at when you're preparing the return that determines whether you're going to have enough paid in. But now that interest rates have come up, the IRS bases those underpayment penalties based on interest rates. Interest rates would fall, we see that go down. But now it's bad enough that, we probably don't want to be paying those penalties, or we want to minimize them as much as you can. So perfect example, let's say here in the fourth quarter, I do which a lot of people do Roth conversions in the fourth quarter. I do a large Roth conversion, and then I wait till April 15th to pay that tax. Well, I'm going to have an underpayment penalty. So I would be wanting to do an estimated payment with that by January 15th when that fourth quarter estimated payment is due. The other thing I could do is if I'm taking other money out of my IRA, say I have RMDs coming out, I can withhold a lot of money there. And withholding was really good because it's as though the money was there equally all year long, as opposed to just paid in that fourth quarter. So what you do when you do pay that in the fourth quarter, and a lot of tax preparers will not know this and not even think about it, is when that underpayment calculation comes in and shows a penalty. Well, if you do what's called the annualized method, where I say, here's how my income came in this year and here's how I paid you, you could mitigate, substantially all or most of that penalty, assuming we didn't have a lot of crazy stuff, earlier in the year. So you need to really let your tax preparer know, hey, I did this conversion in the fourth quarter. I made this estimated payment.
Right. You talked a little bit earlier, Marty, about maybe accelerating some gifts so that you can itemize or doing a donor advised fund. You went over that pretty quickly. So for people that aren't really familiar with what you're talking about, can you just give us a little more explanation there?
So right now we have a situation where the standard deduction is really high, and a lot of people do not itemize their deductions, but they're very charitable. And let's say they're making $15,000 a year in charitable contributions, and they're still not getting over the hump because they don't have a mortgage, and they've got the $10,000 limitation on state and local taxes. So they're still not itemized.
So they're getting no tax benefit for giving that charitable donation.
Correct. So if I stack all my deductions, my charitable contributions in 1 year, and one way to do that is with a donor advised fund, or you can just give it directly to the charity, and next year you don't give them anything.
Yeah, but then when you give them a big gift, they want the same thing next year.
Exactly. That's why the donor advised fund works really well. Plus you're in control in case you decide that charity does something and you don't like them anymore. You can always take that donor advised fund and direct it to another charity. So
the donor advised fund essentially allows an individual to put 2, 3, 4, 5, 6 years worth of contributions, whatever you want to put in there. And then
Right.
each year you basically say, this is where I want the money to go. You don't get the deduction in the year where you send the money to charity. You get the deduction in the year where you gave the money to the donor advised fund.
Correct. But what you really want to do is you need to look at your age also, because if I'm close to 70 and a half, where I can start doing the QCDs out of my IRA directly to the charity, that's the best of all situations. So I don't want to overfund that if I'm going to be within, let's say next year I turn 70 and a half. So this year maybe I do my donor advised fund, because I can't do those QCDs until I'm exactly 70 and a half.
Yeah, 70 and a half or more.
Or more. Exactly. So there's always some planning you do around that. And so what you might do is say I'm 67. I say, okay, I'm 70 and a half in a few years. I put enough into the donor advised fund now and get the deduction, which then could also give me some opportunities to do more Roth conversion, even because I've got that higher itemized deduction now. Stacking those itemized deductions makes sense. But then you also have to be aware of, okay, in 2026, if Congress does nothing and we have the higher rates and we go back to the personal exemptions and a lower standard deduction, maybe that larger donor advised fund contribution might be better in 2026 than it is this year.
But all what you're basically saying, Marty, is while we're talking about tax planning tips for the end of 2024, you're really saying that a good CPA should be working with the financial planner and creating a multi-year strategy so that you're not just looking at 1 year at a time. So you started off the program today by saying, hey, we're looking at laser focused on the next 3 years. Talk more about why that's so important. And I think looking even beyond that, once you understand a person's financial situation, there's a lot that you can do to mitigate and control taxes, especially in retirement. So I'm anxious to hear from you what we're thinking about here over the next 3 years.
Yeah. So for this year, like I said, a lot of stuff is a lot of what we've been doing. Going into next year, so I filed my 2024 tax return in 2025. For some people, we may want to go ahead and file an extension if there's things on your return where you can make a decision how you want to treat it in that year after the end of the year. The perfect example is somebody has an installment sale. They sell a piece of land or something on a contract. We have the option to pay all the taxes in 1 year, or we can spread it out over the life of that contract. So if I'm on an extension, I don't have to make that decision until I file my return. And the other thing is, like for the small business owner, they buy some equipment, or the rental property, owner, they do some remodeling, things like that. The question becomes, do I accelerate these deductions or not? And if you file that extension, you're buying more time. So we get closer to the end of 2025, where maybe we'll have a better picture of what the tax law might look like based on, proposals and things like that are happening.
Interesting. So there may be things that you won't really know what 26 is going to look like until later in the year.
We might have a better idea.
Yeah.
Even though the tax law may not pass until December 31st of 2025.
Right.
At least we'll have, some probabilities.
Interesting. Okay. All right. And there are a lot of people that may have never filed an extension.
Right.
I can't imagine that myself. I think I've not filed an extension once in the last 30 years. It's almost just like, okay, filing an extension because we got all the way till October 15th to deal with everything.
Right.
People think that is a dangerous thing. It's a red flag to the IRS.
No, it's right. Normal. It's normal. And you're seeing more and more of those because people are invested in things that are producing K1s that don't show up until much later anyway. So, But for some people, you're not going to hurt yourself as long as you've got the money paid in that you might owe in a worst case scenario.
Right. So what you're saying is, if you file an extension, it's an extension of a time to file, but not an extension of a time to pay.
Correct.
So you'll have, in most cases, a general idea of what someone is going to owe or a refund that they may get. Now, the people that are going to get a big refund, they probably don't want to file an extension.
Right. Well, maybe, because if there's an election I can make that could increase that refund and I have to wait a little bit, to get that, that's fine.
Yeah.
There's still those people that might want to consider that. But the average person who doesn't have these things on their return, they would go ahead and file.
Marty, from an estate planning and an estate tax perspective, that changes in 2026 as well. So talk a little bit about how, if somebody passes away this year, next year, what do they need to do in order to capture the current estate tax exemption?
Yeah. So if you're married, we're talking about a married couple.
Yes.
So right now we're almost $14 million of exemption for each of them. We're assuming we don't have like a bypass trust set up or anything like that. And for some people, the bypass trust makes sense because of the asset protection features that trust immediately provides. But then the downside is that I'm going to be losing step up in basis in those assets at some point in time. One of the things that you would do if you're on that bubble is that you would file a 706 for that deceased spouse. The surviving spouse would then capture that $14 million that would lay on top of their exemption, whatever that's going to be whenever they pass away. So if it goes down to the $7 million in 2026, and my spouse had died, I have my $7 million plus the spouse's unused exemption of about $14 million. And it's one of those things I would look at it now. So there's been a lot of people who have passed away in the last few years, and they haven't done this. The IRS has put in provisions to allow you to go back and file that 706 and capture that exemption now.
That's a big deal.
It's a big deal.
And the other thing I think, along we're talking about, somebody passing away, is if you owned property jointly with your spouse, you need to get a step up in basis on half of that property or half of that, whether it be a piece of real estate, whether it be land, whether it be stocks or mutual funds or ETFs. Speak a little bit about that.
Again, you have to consider whether I'm in a community property state or a non-community property state. It's like here in Indiana, we are not a community property state. So if I have a joint account with my spouse, half of that will step up in basis and my half does not. Some of the planning that we do around this, say we have a spouse that's not very healthy and we know is going to pass away first. As long as they're alive for a year, this works. So we'll take these unrealized gain properties, put them only in that spouse's name. The properties that have unrealized losses, we'll put those in the healthy spouse's lives, and we could realize those losses, not lose any of our carryover if it was in a joint basis. But then that less healthy spouse passes away, now the surviving spouse has a step-up basis in that, as long as we clear that 1-year hurdle. And I want to add one more thing. So if you have more of a higher net worth couple that would be subject to estate taxes, and we're considering doing what's called a slat or a slant, it's basically where one spouse creates another trust for their spouse. It's spousal lifetime access trust, basically is what it is. But if all my assets are jointly owned, you can't hardly do that in the short time frame that we might have to do this. So you need to be looking at taking your accounts and actually splitting them individually between the two spouses. And then after this is seasoned a little bit, then one spouse can take their money, put it in that slat. And so we're at that point where we need to be doing this, because if this thing, sunsets the way it is, there's going to be a lot of people scrambling. So the plan is you start working on your documents now if you're probably going to do this, but you don't fully fund this thing because, it is an irrevocable trust. Kind of wait until, post-election, see what happens, and then maybe you fund a little bit of it, and then as you get more information, you fund it before the end of 2025 completely.
Yeah, there's a lot of things. And again, I think if we can just kind of wrap this up, Marty, by reiterating the fact that taxes are going to be one of the largest wealth eroding factors facing you as you head into and through retirement. But during your retirement years, you have more control over your taxes than you ever had during your working lifetime. But you got to be proactive in planning for this, and you need a good CPA that's working with your CFP. And that's what we do here at Modern Wealth, is we make sure that our CPAs and our CFPs are working closely together on behalf of our clients to make sure that we're looking for those long-term tax savings opportunities. And the idea is never to pay as little tax in 1 year as possible. The idea is to pay as little tax over a lifetime as possible.
That's correct.
Good stuff, Marty. Thanks for taking the time to join us here on the Modern Wealth Management Educational Series. Thanks again for joining us here on the Modern Wealth Management Educational Series. If there's anything we can help you with, things that brought to mind here, please reach out and we'll get an appointment set with you. If you enjoyed this, please like and share, and make sure that you're subscribed to our YouTube channel.